it's all about risk mitigation and multiple exit strategies, right? So you want to be diversified into something that you can do multiple things with. Like I said, I just had 4 exit strategies. One, we can buy this thing and just flip it to another developer. And by the way, you're not buying it in the as-is value. Like I said, when you have to purchase a multifamily unit over here, the value is not there yet. There's speculation that you can perform and interest rates don't do anything. I mean, you're kind of hoping that things turn out the way they are. And as you can see right now, there's a lot of multifamily deals that are in a lot of trouble because nobody saw what was going to happen with interest rates. And unfortunately, there's going to be a lot of investors that lose everything with multifamily investments. With land, however, we're buying it with the value already there. The partners are putting their money into the civil engineering and time with the city to force appreciate it ahead of time and create a bunch of equity.
Welcome to the Cashflow Fight Club podcast. I'm Mike Deaton.
And I'm Lygia Deaton. Together as co-hosts in life, business, and this podcast, we're matching up the heavyweights of cash flow creation to see who reigns supreme.
We do this so you can discover the best way for you to generate transformational cash flow and pursue the life of your dreams. So whether you're a side hustle seeker, full-time entrepreneur, or just looking to create job-quitting cash flow like we did, hit subscribe and grab your ringside seat for the most entertaining and informative investing show on the airwaves. Let's get in the arena.
Let's do it.
If you're familiar with us and with the show, then you know we love land and multifamily. There's such a powerful combination of income, wealth building, and tax advantages.
Well, today we have a great matchup between the two. On one side, land development, buying in the right locations and adding value to generate outsized returns. That can be rezoning for different uses, roughing in infrastructure like roads, water, and sewers, or even taking it all the way to building out structures on the land and renting out homes or multifamily.
On the other side, value add multifamily. Buying an asset at the right price, sprucing it up on the exterior and or the interior, adding better management, and ultimately generating more profits through better rent pricing and expense management. It's a great way to generate returns for investors and deliver tax savings.
Which one will come out on top? Well, let's get right to it.
Coming to us from Salem, Utah, our first guest mentored with a family member who was crushing it in the world of multifamily investments to get his start. He moved to Maui to get his education in multifamily and now has built up a portfolio of over 450 units and $40 million. Building and living his dream life in Salem, Utah, he loves anything outdoors and investing and helping others find financial freedom through multifamily. Please welcome Alec, the renovator Beardhall. And fighting out of Nashville, Tennessee, our next guest jumped into his real estate career after leaving a successful medical device sales career. He started out as a fund manager focused on new home development and build-to-rent communities. He's now the owner and partner at HBG Capital, where he and his partner focus on buying and developing raw land to serve the greater Nashville community and generate some great returns for investors. Managing over $22 million in new development, please welcome Brandon, the excavator Cobb. These two young real estate titans are tapping into some epic ways to generate amazing cash flow. So let's jump into the arena and get ready to learn how to build a portfolio for financial freedom. Okay, Alec Beardhall and Brandon Cobb, welcome to the Cashflow Fight Club podcast. We're so happy to have you on.
Thank you. Happy to be here for sure.
Excited to be here. This is going to be fun. I brought my boxing gloves today.
That's great. We're bare knuckle in the Cashflow Fight Club arena, but you can wear your gloves if you want. No, it's all good. So yeah, today I'm excited. I mean, we're talking about two things that Lygia and I are both involved in to some degree, at least, multifamily investing as well as vacant land, near and dear to our hearts. So happy to dive right in. Just a quick recap for the audience. We divide this up into 3 rounds. First round is just getting to know Alec and Brandon, a little bit about how they got into real estate and where they are. Round 2, we'll dive into the business model and how you can expect to get some returns out of it. And round 3, we'll dive a little deeper. Any unanswered questions, kind of probe each other's business models and look for the highs and the lows. So with that, let's jump into round one. And Brandon, why don't you start off for us and just give us the rundown? What's your background? What brought you into real estate, and anything else you'd like to share?
Yeah, sure. So, to date, we're doing about 22 million per year in annual development. Now, most of that, our bread and butter, is affordable entry level single family housing and build to rent communities. But once upon a time, that wasn't the case. I was in medical device sales. I was that guy that if you had like a torn labrum, ACL, I'd be sitting right there side by side with the doctor, helping implant that in you, get you back up and running. And I never really had any dreams to be an entrepreneur. I thought that what I did is what I was going to do for the rest of my life. I had found my dream job. I mean, what kid in his early 20s that wore scrubs every single day and got to be in surgery every single day wouldn't love that? So, rubbing shoulders every day with orthopedic surgeons and hospital staff, I loved what I did. I did not have any desire to go out. Real estate wasn't even on my map 8 years ago. But I got sat down one Friday afternoon, sunny day in June, kind of one of those days where like the summer's kind of, moving in, and excited to tell my boss about a great trial that I had with this surgeon and this capital equipment. I mean, it was one of the best days you could possibly have as a sales rep, right? The whole other rep was screwing up. I was over there like just licking my chops going, heck yeah, this is awesome. And before I could get the news out to my boss, he fired me. And that was basically my wake-up call that nobody was going to look out for my financial well-being but me. And so, fast forward 7 years, we do a lot of land development, started flipping houses initially, kind of graduated up and doing a lot of spec. As a lot of people, ran out of my own money, had a need to start raising capital from investors. So we kind of tested the waters with our own money first, and then started to get into bigger and bigger projects and said, wow, it takes just as much time and effort to focus on, building a community of 50, 60 homes as it does to be spread out all over the place doing, 5, 10, 15 homes. And so that's how we got into doing land development, when we realized that you could really add value to the community by going to the city, sitting down with the planning commission, identifying what their vision for the community is. And the idea is to go after the land that's not the highest and best use in their eyes, and then taking it and rezoning it and force appreciating the value of that land through that rezoning process, working with the city to add value to not only the city, but the community as well, the residents, our investors and ourselves. And so that's a little recap on how we got started and kind of what we're doing today.
All right, nice. Yeah, you're teasing us a little bit on where we'll get into round two, but that's cool. So yeah, I mean, definitely sounds like you went from the highest of highs, coming off a great performance, to what have you done for me lately? Thanks. Your severance check will be in the mail.
Yeah. Really confusing when you got all these cool sales awards that they just give you, and then the next day you don't have a job.
We often say that job security is an illusion, really, because you never know when that surprise hits you.
Yeah, it's tough. Well, thanks for sharing that. Let's shift over to Alec. Give us a little bit about your background as well, and where you came from, and what brought you into the world of multifamilies.
Yeah, for sure. So Alec Beardhall, I'm from a small town in Utah called Salem, about an hour south of Salt Lake. And kind of opposite of Brandon here, I have always been an entrepreneur. So I started my first business when I was 9. I had a little lawn care business here in Utah.
Yes, go lawn care. Love that.
Yes, sir. So I grew that to about 20 clients. Had a couple of my buddies working for me all the way through high school.
Nice.
I ended up selling that right after I graduated. So that was kind of my first.
That's great. You had a business exit in high school.
Business exit, yeah. It was pretty fun. But yeah, so that was kind of, the upbringing for me in business. I then took, a couple of years off. I got, a big check and just decided to kind of just, be a teenager. And then, I kind of got into the multifamily space a little bit unconventional. I actually have a cousin that's in the multifamily space named Tyler Devereaux. There's a big age gap between us, so I never really, had a good relationship with him. But, just Facebook posts, I saw him. He actually moved his family out to Maui. And I, at that point was like, what is this guy really doing? I didn't really, all I knew is he was in real estate and didn't know what that was. So I ended up reaching out to him and started picking his brain. And after about a year of that, Tyler invited me to come move out to Maui with him. So I went out there. I was his personal assistant and helped them start their new education company called the Multifamily Mindset. And in return for that, he was going to be my personal mentor and teach me everything about the multifamily space. So moved out to Maui and, lived in paradise and learned the multifamily world. And since then, we've bought about 496 units now. We just closed on our latest deal down in Tucson. But yeah, what's kind of where I got into the space and how many deals we've done. So.
That's great. Yeah, mentors are invaluable. Nice if it's a relative as well. When you moved to Maui, was your cousin doing multifamily in Hawaii, or was he doing remote? You were just kind of learning the business.
Yeah, good question. Nothing in Hawaii. So his portfolio is mainly in the Sunbelt states between Texas and Florida. So.
Okay, interesting. That's a great place to go learn.
Yeah, not a bad place to learn for sure.
That's terrific. I love that.
And hearing you talk seems like the entrepreneurial bug was very early implanted into you. For some reason, I'm so curious to find out what made you want to start a business when you were 9 years old.
Yeah, it's a good question. Biggest thing for me, I wanted to buy a 4-wheeler. And so there were some people in our neighborhood that had 4-wheelers, and not that our family was poor by any means, but we didn't, have any, extra, money for toys like that. And so I was like, how do I get a 4-wheeler? And, that was making money. And so I kind of just started for different avenues. But a lot of people don't want to trust a 9-year-old, with much more than their grass. So that's kind of where I started.
Oh, that's awesome.
Yeah, that's a great gift you were given, really, as a young kid to want something and then to go figure out you have the means to figure out how to save up and earn some money and go get it. I also started around the 10 or 11-year-old mark. My dad was a home builder. And so I became an employee. He would take me out, drop me off at some of his homes that he was building, and I would just spend all day cutting yards and earning a paycheck. Entrepreneurial way would have maybe been a much better way to go about doing it.
I love it.
Well, that's cool. Alec, why don't we stay with you? Let's jump into round 2 and just give the audience a bit more flavor about what you guys do in terms of multifamily, your sizes of property, asset class type, what kind of return profile people can earn, things like that.
Yeah, for sure. So here at High Country Capital Partners, we do what's called a apartment syndication. So essentially, we're bringing our own capital and bringing capital from our investors and combining them to go buy large apartment complexes that we wouldn't be able to buy just individually. So we're, really giving, in a short overview, the opportunity for people to own and invest in real estate without the headaches of ever managing it and, dealing with tenants and toilets and trash. So that's kind of what we do as far as, the actual real estate side of things. So we focus on what we call a light value add multifamily deal. So a few examples of a light value add deal is like a new build that has really bad management on it. And so they've got high vacancy, or a property that's been a little bit older, like a 70s or 80s deal that's fully renovated. And then, they have low rent, so they're at 100% occupancy, and then have bad management or something like that. So we focus, a lot of people, the word value add is thrown around a lot in the multifamily space. And that can range from, a 50% occupied, class D, just total clunker, all the way up to, the bushes and trees aren't trimmed outside. There's some deferred maintenance. But yeah, we like to kind of do, the higher end side of the value add space. And that's what's, given us, the most success at this point. So as far as, properties go, we look from about 1980 to 2010 range of properties. And then we look for properties anywhere from 50, and we've gone as high as 419 units. So we've got big range. Our lowest deal was 38 units, and our biggest deal was 419. So, but age wise, I think I said age wise 1980 to 2010. Got unit count in there. I can't think of anything else that we.
Yeah, it's a great way to go about it. To your point, value add is thrown about. There's a lot of ways to add value, and basically in these rental markets, really the thing that's being chased is to increase the top line and reduce the bottom line, right? So that for a commercial type property, you're forcing the appreciation and increasing the value, which upon a refinance or a resale, you can extract some value. As far as an investor perspective, are you chasing a particular return profile? I know, a lot of the deals that we look at are 15 to 20% type annual returns over a 5 to 6 year hold period or something like that. Is that similar to your business model?
Yeah, very similar. So our baseline is a 15% annual return. We've had one exit at this point, and we average about a 28% return on that. So we look for an underwriting 15 to 18% on annual, and then our cash flow return, our baseline is 7%. So 7 to 10% is what we're looking for. Investors, from an investor perspective, they could, what they would be receiving is a 7% annual cash flow return paid out quarterly, and then they would get an equity check when we sell the property as well.
Right. Yeah. And typically that's like a 2x overall return on your, like if you put 100K in, you're walking away with 200K.
Correct. Yeah. That's the goal for sure. So 3 to 5 year holds on our end as well. So.
Okay. Yeah. Pretty standard value add type business model. Okay. Well, we'll save a few questions for the third round here, but Brandon, why don't you dive into a little bit about the land development? I think that's at least from my perspective, more people don't necessarily understand all the ways in which you can also force appreciation in vacant land and extract some value. So give us the ins and outs of that.
Yeah, so we've got 4 different exit strategies when it comes to doing development. So exit strategy number 1 is to force appreciate the value of that land and then sell it off to another developer. What's unique is you can do industrial, you can do multifamily like Alec does, you can do single family housing, you can do build to rent communities, you can do commercial. So it's really diversified on the front end. Second is, let's say you want to go contract and sell that land when you have put all of the utilities and stuff in it. You can go find an end buyer who will give you a contract up front, any 10% down payment. Say they want to pay $10 million for it. They'll give you $1 million up front and say, hey, here's money to go do the development, and I'm going to buy it in the end when you finish it. That's exit strategy number 2. Exit strategy number 3 is you actually develop it and build yourself. So let's say we've got some single family entry-level communities that we're currently building. And so we'll build and we'll sell those off to consumers who need a house. Usually it's a first-time home buyer. And then exit strategy number 4 is to actually build and hold it. So similar strategy to what Alec is doing right here. Here's where we're different. We start with the community in mind. So we'll actually go to these municipalities. Typically, we're going after the ones that are developer friendly and the ones that have first-time home buyer housing. So, we're not going to the neighborhoods where you can build $2 million homes, right? These are first-time home buyers. We do that because right now, less than 10% of the homes being built cater to first-time home buyers. But you have 33% of the home buying population that needs to purchase a home. These are millennials. They're having babies. They need to buy a house, and there's just no housing for them. So this is why you hear a lot of the affordable housing crisis, on the news. So it starts with working with the local municipalities to identify what's lacking in the community. What does the community need? What are the citizens complaining about? What can we do to increase tax revenue and invest back into the community? And then we reverse engineer that vision by going after those parcels that are not the highest and best use. We'll put it under contract with the homeowner, the partners, myself and my partners. We then spend the money to force appreciate the land. And we do that by taking it from, a piece of land that you can't really do a whole lot on to a piece of land that might be good for 3 or 4 industrial buildings. It might now be good for 100 single family communities. You might be able to put a mixed use commercial building on it. So that's how we force appreciate the value of the land. We could take it from agricultural or residential to something where you can put a lot of density on it. And that's how we force appreciate the value of that land ahead of time before we even buy it. So I don't have to go buy a multifamily property and execute a value add strategy and hope that interest rates and all these other things happen to it or don't happen to it. I can buy this piece of land while the value has been created in it through that rezone process, force appreciating it.
Yeah, it really is a versatile business model. I'm curious. So you mentioned in one scenario, a buyer will front you capital to do your improvements and then ultimately buy the property. Are the other types of investments, or even in that type of investment, are you bringing investors in as well to in syndication style or anything like that?
Yeah. So let's say exit strategy number one is when we put it under contract and we spend the money on the civil engineering ourselves, and we'll either usually have an end buyer already lined up, or we'll raise funds from investors to do land banking. Say it's in an area where we need to, like, it's path of progress and we know a lot's going on. We might hold on to it for a year or two and then just sell it to another developer. But if we want to develop it, let's say that there's we did a deal with LGI Homes, national home builder, right? They said, hey, we will pay you guys $70,000 per townhome pad here. Will you develop it for us? We'll give you a 10% deposit. So we go under contract with them. They literally release 10% of the purchase price to us when we have the funds already syndicated with our investors to do the development. And we're not using any bank debt. It's 100% equity from investors. So we completely control that debt. And we've got a buyer who's kind of locked in and they've got a lot of skin in the game. You know, when you're selling stuff for millions of dollars and they're giving you, $200,000, $300,000, $400,000, $500,000, $600,000 down payments, that's either profit up front. We like that. Or, hey, if they, end up walking from it, then you can keep that and you can just go on to the next guy and sell it. So it's kind of nice having an exit strategy already lined up if you were to do all the horizontal development. And when I say horizontal development, I'm talking about creating finished ready home pads. In other words, roads are in, it's got water, it's got sewer, etc.
Right. Yeah, it's great. In that type of scenario where you're bringing investors in, I know things vary deal to deal, but is there an average or some type of typical return profile that you can communicate?
Yeah, we're pretty straightforward. We do an 18% pref. So no fancy schmancy waterfall structures here. We've got to hit that 18% pref until we, the partners, make money.
Mm-hmm. Great. Love that. Investors love it. All right. Alec mentioned Sunbelt is his target. What about you guys? Are you market agnostic? Are you looking just in the Nashville area, or where do you cast your net?
Yeah, we're strictly in the Nashville, Tennessee market. We like Nashville, Tennessee because it's seen an influx of about $7 billion of institutional capital since 2021 and 2022, right? I guess COVID scared away all the institutional guys out of the non-business friendly states, and they've been flocking to states like Texas, Florida, and Tennessee. So just to give you an idea, I mean, we had $5 billion of institutional investment from 2010 to 2018. And we currently have under construction $7 billion. I would say if you want to see something entertaining, go type in Nashville skyline before after, and you'll see what the skyline looked with all the buildings before and what it looked like after 2020. I mean, it's wild how many buildings popped up in the last 10 years. So we like Nashville because there's a ton of institutional capital coming here. You've got major businesses building like Amazon, Oracle, Alliance Bernstein have set up shop here, Dell. So the local incentives, tax incentives specifically, that the city is offering these larger corporations to move here is just absolutely unprecedented. So it's moving a lot of jobs, and you're moving a lot of jobs somewhere, you're moving a lot of people. And so we're just seeing a huge influx of people coming into Nashville, and people bring money. And I don't know about you guys, but when I'm looking for somewhere to park my money, all I care about is money going to continue to pour into that asset for the foreseeable future, right? Hey, if we could be in toilet paper during COVID, right, I think we'd all feel pretty safe. Don't care what's going on with the economy. I want to be where the money's at. And the money is in Nashville, Tennessee.
Yeah, as well as a few areas that you mentioned. It is a certain tried and true strategy. Yeah, I mean, there's definitely net influx of migration into some of those key areas, and it's a great place to be and be doing business. It is a costly place. I mean, I'm sure the land is not cheap, and it's getting more and more expensive because of that very fact, right? I mean, there's just supply and demand.
Brandon, I'm sorry.
Go for it.
Brandon, I'm curious, how do you guys find your deals? Is it through direct reach to owners, or you look at the listings, brokers? How do you guys find your best deals?
Yeah, so all the above. But again, it starts with sitting down with the city. You got to remember, those planning commission electorates, they know everybody. There's a reason they're sitting on that board. And they're a great resource to have, especially when you've proven yourself a couple times. Deals find you. You don't have to worry about it. So we use a lot of relationships. We also, there's a great app called Landglide. And if you pull it up, it looks like a giant puzzle, right? All the little pieces and parcels of land are like little puzzle pieces. What you're looking for are a ton of little bitty, itty bitty, small puzzle pieces that show density, and a large puzzle piece kind of right next to it. Right. So we've got a pretty good idea of what we want to target and the parcels we want to target. And so we do a mix. It's relationships with the planning council, the city, the local members of the community, brokers, and also we do some direct outreach.
Love it. Yeah, you got to work all the angles, but definitely, city planners are great, a great network to have for development and things like that. I mean, like I said, they're looking out years in advance. They know where things are headed, and generally have the inside scoop. All right. Well, one other question I did have, and there may not be a straightforward answer to this, Brandon, but is there when you guys are buying land, is there a typical size that you're purchasing? Are we talking 10 acres here? Are we talking 100 acres, 10,000? What's kind of working there?
Yeah, our kind of minimum standard is 50 to 100 units. And to achieve that, you really need between 5 and 10 acres. And of course, it's going to depend on the density. Can you get townhomes on it versus single family? If it's single family, what size the lots need to be? We're looking at a lot of stuff that's over 10 acres mostly.
Okay. But right in that pocket somewhere, depending on the project, of course, and what the needs are. Right on. Well, let's swing into round 3 and just go a little bit deeper. Brandon, from an investor's standpoint, aside from a healthy pref that you're promising them, what other ancillary benefits do investors get from jumping into something like this?
Well, it's all about risk mitigation and multiple exit strategies, right? So you want to be diversified into something that you can do multiple things with. Like I said, I just had 4 exit strategies. One, we can buy this thing and just flip it to another developer. And by the way, you're not buying it in the as-is value. Like I said, when you have to purchase a multifamily unit over here, the value is not there yet. There's speculation that you can perform and interest rates don't do anything. I mean, you're kind of hoping that things turn out the way they are. And as you can see right now, there's a lot of multifamily deals that are in a lot of trouble because nobody saw what was going to happen with interest rates. And unfortunately, there's going to be a lot of investors that lose everything with multifamily investments. With land, however, we're buying it with the value already there. The partners are putting their money into the civil engineering and time with the city to force appreciate it ahead of time and create a bunch of equity. I'll give you an example. We're about to start developing 74 homes for a national builder, and we bought that piece of land for I think $700,000, so about less than $10,000 per pad. We probably spent $40,000 or $50,000 in civil engineering fees. We could sell that today for about $22,000, $23,000 per pad. So we've force appreciated the land by about $800,000, $900,000. That means that land would have to take a 50% hit to break even for investors. That's 50% to break even for investors. And so again, that's just exit strategy number 1, is just turning around and selling it. But we don't want to do that. We want to have multiple baked in. So we can then syndicate with investors, raise the funds that we need to do the development, contract with a builder, which is who we've done in this case, and we can put all the infrastructure in, develop it, and we can sell the finished pads to that builder. Let's say that builder backs out at this point and says, you know what, we don't want to do this. we're done, we're walking away for whatever reason. Well, now we've got a piece of land that's worth even more money. It's ready for 74 homes. I can either go and sell it to somebody else, or if I have to, I can use the equity in that land to build my own houses. Because believe me, there's a lot of equity baked in. You can very easily get loans on that land now that the value is there. And so I can build and sell my homes. And let's say that doesn't work out, for example, another COVID wave hits or interest rates go up. As long as I've underwritten those homes to rent, now I can utilize Alec's strategy here, and I can just rent them out and use it as a multifamily value add. And here's the kicker, and this is why it's better than multifamily, Alec. I can turn around today if that doesn't work, and I can sell those homes to consumers, or I can rent it out as a multifamily unit. I'm not bottlenecked into renting it, where you can't sell a multifamily unit to a bunch of individual buyers. I can turn around and I can either sell it to a big old build to rent fund that wants to purchase it, or I can hang on to it myself, or I can sell it as individual single family homes. So that's number one, is the multiple exit strategies. Number two is we control the debt. You're seeing this wave of distress in the commercial, the office space, the multifamily, because of all the bridge debt that was taken down. Loans that are coming due on their 5-year terms that they can't refinance out of. The beautiful thing about up until we go and build it, we control the debt. It's 100% equity from investors. So if we get some kind of market event and we're about to go vertical on it, we can just hang on to it and cancel the construction loans. We can just say, hey, we're going to hang on to this for as long as it needs. And this piece of land that I'm talking about right here for 70 homes, we bought that in the summer of 2022, right before interest rates went up. Guess what happened? All the craziness for the past year and a half. Guess what didn't happen? It didn't get foreclosed on, right? We just hung on to it. We sat on it with ourselves and our investors because, again, we control it. So we didn't have that debt that was coming due that the bank could call the note on us. So that was another big benefit of it. Those are two really, really big benefits, and I'll kind of leave it right there. We can dive into more if you want.
Okay. Yeah. Only other question that is top of mind is: Are there any tax breaks? Like land, typically doesn't depreciate, and so you don't get with it certain tax benefits. But I'm just not sure in this situation if that holds true, or if there's some other allocation for it.
No tax benefits unless we build to rent. So if we're doing a build to rent community, in that case, yes, there would be depreciation benefits.
Yeah, which get a dwelling of some kind on it or something there. Okay, that's what I thought. All right, great rundown. Love it. Love the flexibility and all of that. Alec, why don't you give us a little bit about what the other benefits are with multifamily, as well as how you guys go about doing any risk mitigation?
Yeah, no, I love it. Well, there's really two big things why people, invest with us and invest, in multifamily in general. And those two things are going to be, cash flow with, it's a completely passive return. And the second one is going to be the tax benefit. So, unlike the, vacant land side of things, we get very big tax breaks in owning multifamily. Essentially the government looks at it as, I like to say, thank you for housing our citizens. Here's a big tax break for you. So we're able to, pass through our depreciation schedule straight to our investors. And in most cases, we're also able to do what's called a cost segregation study. And we're able to actually speed up and do bonus depreciation on our deals as well. So instead of, depreciating, our asset over, I believe it's like a 36 or 37 year period, we can bring it down and cut it down into the 20 range. So we're able to give people really big tax breaks on that. And then, the cash flow side of things is, it's a little bit less, 18% pref, that's amazing for sure. There's definitely some trade-offs with it. We do, typically it's between a 6 and an 8% preferred return. And then, they get a big equity check when we refinance or sell that property. So those are, I would think the two biggest things people invest with us for. If I would add a third, it's, really just a total hands-off, strategy where they, all they're doing is vetting us as a deal sponsor, and then, hitting the invest now button basically. So, after that, they don't really have any say in what we do. But that's really where you had mentioned, some multifamily in the last few years is, it's been some turmoil for sure. And really, when times go bad like this, it really exposes the good operators from the bad operators. And unfortunately, there's been a lot of bad operators come into the space in the last 5-6 years. And I like to call it kind of dumb money. And they were able to raise a bunch of money and run these assets at a subpar level. And once debt came up and taxes have gone up, insurance has gone up, it really starts exposing how poor they run those properties. So yeah, I mean, from an investor's perspective, they really, all they need to do is vet the sponsor and see if they can perform in a downturn or not. So
I had a quick question on the tax benefits. Does that apply to any person who's got a W-2 job, or maybe you're a doctor or business owner? Can I write that depreciation off against my income, or do I have to have the real estate professional status where I've put at least 750 hours per year to be able to write that depreciation off against my doctor income or my accounting income?
Yeah, it's a good question for sure. It really depends on where you live, and then it really depends on who you use. So we do webinars with our tax person. His name's Vic. And we refer all of our investors over to them. He is able to, put our depreciation against their income. And so it really depends on who you use. If you're going to use somebody that isn't versed in the multifamily, real estate space, a lot of times they're not going to be able to use, what's written in the tax laws to the full benefit. So it's possible, but a lot of people, they just don't want to move, their tax person. And so they end up missing some of that stuff, but it is possible for sure.
And I was under the impression the only way to get the tax benefits with multifamily, like if I'm just a single guy and I'm a doctor, I cannot get those tax benefits because I'm not a real estate professional. But if I'm married to a real estate agent, or my wife flips houses or does something where it's in a real estate transaction and she has that real estate professional status, at that point, because we're filing jointly, can. But I was under the impression that you cannot, under any circumstances, write your doctor income or your accounting income or any other income that's not real estate related against that depreciation. Is that true?
It's a nuanced rule or whatever, how you can do that. I mean, yeah, we're a real estate professional status, both of us. And so we can take unlimited depreciation, right? We get $75K off of a deal that we invested in. We can immediately subtract that against our earnings. But I think in general, the rule is it's a passive loss, and the government wants you to match it up against a passive income. So if you have rental income, or if you have if you get cash flow from these investments, there may be some small percentage allowance or something, but yeah, it's definitely throttled down if you're not working in the real estate space, but it can be carried forward. So I think you can certainly take it against future years to some degree. But yeah, it's a very nuanced topic, and one that gets confused to a lot of investors, I think, because it is a lot of times pitched as, look at all this depreciation that can come your way. And then when you talk to your CPA, they're like, yeah, but you can't take it, kind of thing. So
that's the big problem. You can take it against the real estate income that you receive from the multifamily unit, but you can't write it off against the $500,000 you just made that year as a doctor.
Yeah. And so it is tricky in that way a little bit. And a definite good point to talk about that. Go ahead, Alec.
No, I was just saying it's a good point for sure. It's definitely, there's a lot of loopholes to jump through, and, there's some gray areas, and, but yeah, I mean, it is, a good point that, you can't directly bring it straight from, the depreciation right onto your active income. But yeah, we like it, a lot of people, they just, unfortunately, they miss it. Our goal is to just, inform our investors, educate them on the best strategy that we have found. And, we like to give them the resources for, what we feel like is, our best tax accountant, anyone that way, and, give them the option to do that, and, use them to get that full, benefit in their personal situation. Because really everyone's personal situation is different. They may be in some sort of real estate side, or they may, be just a doctor and do nothing else. So really,
it's a very unique and personal so everybody needs to consult with CPA to understand what they can leverage or not. Alec, both of you guys, but Alec first. Are you guys doing accredited and or non-accredited investments? And what about like minimum investment size?
Yeah, good question. So we've done both a 506B deal, which we can take, both accredited and sophisticated investors. We've also done a straight accredited deal. So really, we look at that, deal specific. Typically, if it's going to be a smaller deal, we'll do a 506B. If people don't know what that means, it essentially means we can accept accredited investors, people that have a net worth of $1 million or make $200,000 a year individually or $300,000 joint with a spouse, and we can then accept people that also do not meet that accreditation status. The trade-off there is we can't market to the open public. And then on the 506C side, we've done 2 deals on the 506C side at this point, which means we can only take accredited investors, but we can also market to the general public. So really, there's some trade-offs there, but we do both. Typically, our investment minimum is $50,000. We've gone down on a smaller deal to $25,000 to accommodate some family members, but other than that, yeah, typically $50,000.
Yeah, so we do 506B. Everybody gets me personally. I set up phone calls and Zoom calls with every single person that eventually invests with us. So we establish a relationship there beforehand. And that's really important to us because I've got my money in multiple other people's syndications. And primarily I do that, one, because I like the space, but 2, I'm looking for what's lacking. I want to see how we can differentiate because it's all about the experience. Any business going forward in the future is going to have to be able to deliver an amazing customer experience, or they're not going to get that customer back. This is why you saw CrowdStreet having such a difficult time raising money when COVID came in, because there's no personal connection with the brand. There was no relationship there. It was just like, I'm just going to kind of throw my money in here. And so that's one of the reasons why we don't just do like marketing for accredited investors. And it's like, hey, click these buttons and it's all automated. And, we never have to see you and you got your money. We actually want that relationship to be there. We want to be able to have a one-on-one conversation multiple times and actually understand what your real needs are and what you're trying to build. And we want to help you get there because not everything that we have is right for everybody. And that's what we figure out on our one-on-one calls is what are you trying to build? What's your current portfolio look like? What's your investment experience? What's your sophistication? I can't tell you how many calls I get on and people don't have an emergency fund saved up. And I'm like, look, you don't need to be investing this money. You need an emergency fund saved up first. Let's put away 6, 7, 8 months worth of expenses. And so we want a tailored experience with all of our investments. We want investors to feel like we're not just taking their money and kind of running with it, but we're taking it with the intent to actually build out what they want. We want everybody to build a legacy, make an impact with loved ones, and ultimately retire. And so there's not a one-size-fits-all pill for that. We need a little bit more of a tailored approach.
Yeah, love that. Definitely, it's on both sides, in multifamily and the land. I know there's a range of the way people treat investors and clients, and it's an important point. And it's not exactly related to my next question, but let's include it in. I did want to talk to each of you about how you are structuring your operations and running things. And on the multifamily side, Alec, I know there's property management companies and asset managers, whether that's in-house or out-of-house. But we could also expand that to investor communications and how well that runs. And then, Brandon, I know on your side, it sounds like in the development space, there's a range of contractors that need to be brought in. I'm curious if you guys are subcontracting that out, or if you have any or all of that in-house, and as well, it sounds like your investor communications is pretty important, so you probably got that dialed on in-house. But Brandon, let's stay with you maybe and just run through that for me, how that works.
Yeah, so currently we're vertically integrated. We do everything in-house. We manage everything in-house, and this is why it's better than multifamily. Okay, because I heard this fight club. I threw my gloves off. I'm like, we're going to get really bloody right here. The big problem with multifamily right now is there's so many sponsors out there that have absolutely no control over the deal and they're raising money for it. In other words, they're raising money for somebody else. They're really just they're using a fund of funds model. They're bringing the capital to the table. They have no control over which property management company to do. They have no control over when to sell that asset. literally, I'm talking zero control. They're raising money for somebody else, usually some kind of institutional operator that's built a name brand, and they're doing a fund of funds model where one fund's investing into the other. That's great. But if you're not telling your investors that up front, because I promise you, if every single investor knew which sponsors actually controlled the deal and which didn't, you'd find that it's probably less than 3, 4, or 5% of the actual sponsors that are in control of the deal. The majority of them are not doing that. That is a huge risk to investors. And quite frankly, I think that's why you're seeing a lot of distress in that market. We control 100% of the deal, which means my signature is the decision maker. So everything from purchasing it to which contractors we use. We've got an in-house construction company that we use that manages everything. And we've spent the time to build relationships with these contractors. The biggest problem, either in multifamily or developer, any industry, quite frankly, is that investors get to see the sponsor. They do their research on the sponsor, but they don't realize that the operator, the property management company that's out there, whoever's managing it, the developer that's building it, the builder that's building the communities, that person is, I would argue, almost more important to due diligence on than the sponsor, because they're the ones actually executing on the deal. So I see a lot of people do due diligence on the sponsor and not the actual operator who is managing the performance of that deal. So because of that, that's one of the reasons why we're only in Nashville, Tennessee, is because that's where we live, my partners and I and my team. And so we've got boots on the ground here where we can actually go actively manage everything. Now, we do subcontract everything out. It's not like we own all the equipment and own every single subcontractor. It's like building a house, right? The builder doesn't, he's not an HVAC guy and a plumbing and electric guy. You've got subcontractors that you use to go and execute on your developments, and that's how we're structured.
Mm-hmm. All right, makes sense. Alec, how about you guys?
Yeah, so like you mentioned before, we definitely utilize property management companies. I would definitely agree with you. There's actually a lot of groups that don't really have a controlling actual I guess decision making ability in the syndication space, which I believe that should be communicated to investors for sure. Any deal we personally do at High Country Capital Partners is we have full control. We have voting rights. We still utilize sponsors at this point, but we definitely have the control to make decisions on deals. Whether if we brought in a property management company that's not performing on the asset, we have the control to be able to come in and actually change those people out. So we use 2 property management groups. In Texas, we use Tarantino Property Management, and we've had great experience with them. They are mainly in Texas, but they're also a national property management company. So kind of the structure is they're the on-site staff that is dealing with the tenants day to day, and then we are the asset managers. So they report to us weekly. They give us the stats on the property. They can see how many leads we have coming in to look at vacant units. If there's any repairs that are needing to be done on the property, they communicate all of that with us, and then we basically give them direction on where to spend money and if we need to do different marketing efforts, stuff that way. So they report to us, and we kind of communicate back with them, and then beyond that, really one of the ways we do mitigate, because investors, they're limited partners, so they don't have really any say on, what property management company's in there or not. But at the end of the day, we as, sponsors and operators, we don't get, paid cash flow at all if we don't hit their preferred return. So if a property is, performing at a subpar level, we don't get paid. And, at the end of the day, we all want to get paid too. So, that is one way we, definitely, bring in the right property manager is, if they're not performing, we don't get paid. So we make sure to vet our, property management companies first before we put them on our deals. So,
but you do get paid an acquisition fee and a management fee.
We do for sure. Yeah. So we get we get an acquisition fee right when we close the deal. So investors know about that fee right up front. That's the fee we get for putting the deal together and offering them an opportunity. And then we also do get an asset management fee, which is typically 1% to 2% of the income. So we get paid that just on the line item as well. So we still get a little bit of residual income. just for managing the deal. So they know that as well. But we do definitely still get paid regardless.
So you're leveraging third-party PMs. You guys are asset managing in-house, and then I'm assuming you're doing investor communications in-house as well.
Yeah, all
you're doing
in-house.
investor communications.
Definitely communicate with investors. So our communications are on a monthly timeline. So we give them an update on basically what happened in their specific investment in whatever property they're in. And, we'll give them the ups, the downs. We share straight over all the financials on the deal. So if they're, numbers people, they can go in and look at the P&L and the rent rolls and, see everything right up front. So they can see if we're, a fraud and, saying something, but the numbers reflect something else. So we're very, transparent on how a deal is performing. So we upload that into their investor portal, and all of our updates go through our investor portal as well. But they're able to go in and see, as far as the deal goes back, they'll be able to see financials and the monthly update that we send out. So,
right on. Brandon, one loose thread that I don't, maybe you said it and I didn't catch it, but what's that typical length of term for an investment for an investor?
Yeah, so typically if we're, flipping land to another developer, a year or less. If we're developing and selling it, 1 year or less. If we're developing and building it and selling the houses, 2 years or less. If we're holding it as a build-to-rent community, you're going to look at a 3 to 5 year hold.
Right on. Okay, well, Legend and I are going to take a minute here just to confer, and we'll jump back in. You guys can chat or lick your wounds or whatever there. All right, so the judges have conferred on kind of what you guys presented here today. Awesome business models. Like I said, we're both familiar with each of them, highs and lows, ups and downs. Haven't really gone the land development route, which is a super attractive proposition, something that I think we'll consider. But for this matchup, I think the level of flexibility, the returns, low risk profile is going to give Brandon and land development the nod in this matchup. So champion,
Woo-hoo!
That's right. Congratulations. We're mailing your big gold champion belt to you. You should have that in.
Oh, seriously? I get a gold belt?
And you should have that in a few hundred years. So that'll be.
200. I was getting excited, man. I was like, all right, I'm going to post it up on the wall over here.
A 5-star review goes a long way. We could maybe work something out on that. So, no, congratulations. I think it's a great business model. I mean, it's certainly it's great to have almost de-risked profile. Something I didn't ask was, is there an event where an investor could lose everything? I mean, I'm assuming you could have a buyer back out of a deal or something like that. However unlikely that seems like that would be, but anyway, low risk profile. It's got a great return. I mean, 18 per F. That's just incredible, and quick hold, all kinds of things. So I'm sure you got repeat investors lined up and coming your way. But congratulations, and congratulations to both of you. I mean, they're great business models. We love real estate, transformed our lives, the power of it. It's just an awesome asset class to get into with its risk profiles. I mean, sure, Brandon, to your point, there's a lot of pain in the marketplace right now, and I know a lot of investors are not going to be hitting the returns that they thought they were going to get. In that regard. But anyway, congratulations. I'll let you close out.
Yes, so we like to finish our episodes with gratitude. And Alec, let's start with you. Do you want to shout out to anybody that has been undeniably impacting your life in a good way and helped you be where you are today?
I bet I know the answer.
Yeah, for sure. There's definitely a few people. First and foremost is, my team that I've built around me, Isaac Murray and Tim Beardhall. Those guys, we work day in and day out on the business side of things, and they're, who I pretty much spend the most time with outside of my own family. But definitely those guys. A couple other, people are named Dallas Pruitt and Jackson Campbell. Both of those guys act as more of my mental coaches. There's a lot of mindset that goes into being in the real estate side of things and being an entrepreneur in general. and they've, helped, combat a lot of, stress and a lot of, situations that I've had to kind of work through. So, yeah, those would be the main people that I want to shout out for sure. They have definitely impacted my life, and yeah, definitely
Beautiful.
grateful.
Right. How about you,
Yeah.
Brandon?
Yeah, shout out to Vagiv Sadov, my business partner of 8 years. Wouldn't be the man I am today, the businessman I am today without his guidance and support and motivation.
Love it. Well, we're both grateful for you taking time out of your busy schedules to come and share the ins and outs of your business models and give the audience a little bit of flavor on some alternative type investments. So encourage exploration and further education down that path. Alec, for anybody that wants to get in touch with you and hear a little bit more, what's the best way?
Yeah, best way is just going to our website. It has all the links and call button schedules, and it's High Country, HIGHCOUNTRY, CP as in cat and Paul.com.
Okay, wonderful. Brandon?
Yeah, likewise, if you're somebody who's interested in building a legacy, if you're trying to make an impact with loved ones, if you're trying to retire, you can go to our website, www.hbgcapital.net. That's pronounced Harry, Bob, Gary, capital.net. I joked that the .com was stolen by somebody over in like the UAE over there. But you can go on that website. We've got a free ebook, 100 questions business owners ask before investing. We wrote that ebook with the mindset of, hey, if we could just prevent one green investor from making a bad investment by having the right questions to ask before they invest, then it would be a win. So you can grab that free ebook at our website.
Awesome. Love that. Well, thanks again to you both. We certainly had a blast. Glad it was a fun-spirited matchup, and wish you all the best in 2024 and beyond in your ventures. Thanks for coming on the Cashflow Fight Club podcast. For those of you tuning in, we thank you so much for investing your time with us on the Cashflow Fight Club podcast. We certainly had a blast, received some knockout insights, all while learning something new, and we hope you did too.
If you had fun, please subscribe to the podcast wherever you watch or listen.
Lygia and I truly believe the beauty of cash flow is having your money fight for you instead of you having to fight for money. So whether it's one of these methods or something else, we encourage you to dream big and take action. See you next time.